This week, the US economy sent a mixed but revealing signal: strong fundamentals, but rising uncertainty. The labor market remains solid with the steady job growth and resilient consumer spending. Federal Reserve continue to hold rates, signaling patience rather than urgency. However, inflation risks are quite re-emergent, largely driven by rising oil prices tied to the geopolitical tensions. Markets are increasingly concerned that inflation expectations may become sticky again. Mortgage rates dipped slightly to around 6.4%, offering a short-term relief, but remain elevated overall. Meanwhile, housing is no longer moving as one market. Strong regions are booming while others are correcting, highlighting a fragmented landscape. So here's what's really happening. We're entering a higher for longer but unstable cycle. The economy is strong enough to avoid a recession, but not weak enough for aggressive rate cuts, and not stable enough to fully tame inflation. That's a dangerous middle ground, honestly. So what this means is that, for consumers, you're in a quiet squeeze phase. What does this mean? It means that, your saving yields are still attractive, good for cash holders. And so do you want to spend more or do you want to save more? In the meantime, the everyday cost, especially energy, may be creep higher. So that means that you would rather save than spend. Is that true or not? But this is what the power is trying to get people into, right? So for real estate is that this is now a local but not a national market, which means that it's kind of fragmented over all the regions. Rates are above 6%, of course, that will cap the affordability from the consumers. Prices will not crash though. It depends on the market, but the growth will be uneven. Opportunity means that there might be some mispriced or overlooked stock markets that the investors can tap into, but then it comes to not to buy anything, but to buy selectively. So investors really need to think about, which market, which region, which assets class to get into. And for investors, the public markets, it will continue to have volatility driven by inflation headlines and geopolitics. And the bonds and cash are, finally real competitors to equities. Private market, I have to say this is a buyer's market, and the deals exist. And why do they stay on market for a long time? It's because sellers, they haven't adjusted their price expectations yet, and the buyers are hesitating to buy because of the high interest rate and soft market. The edge flow is that it's more like a timing and discipline issue rather than capital issue. And the bottom line is that this is no longer it's hard to define a bull or bear market, but this is a precision market, and it's a decision market. It's a selection market. The winners in 2026 won't be the most aggressive ones, but they will be the most selective and patient ones. So this is the most recent financial trends in America. And thanks for watching, and like and follow, and we'll see you next time. Thank you. Bye.